Trying to time the exact bottom can be very difficult. But in this video, you'll learn the top 3 option strategies that make it much easier. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and now Miami as well, and proud to have developed numerous great traders. Watch, take notes, and learn from the team at our prop firm so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if any of you are football fans like I am, you'll know that quarterbacks are trained to throw the ball not at the exact location where the receiver is, but where that receiver will be when the ball reaches him. And so professional traders are trained to think that way as well. They're always looking ahead into the big picture to see where things may be headed in the future so that they can profit from that. And so for the last 6 weeks, there's been a large sell-off going on in the markets, and that sell-off has been very intense when it comes to tech stocks, which were the darlings of the market just a few months ago. And so it's no surprise that the tech-heavy NASDAQ index, represented by the ticker symbol NDX, the NASDAQ 100, is off 13.6% from its highs in mid-February compared to the broader market, which is off under 10%. And so when this kind of a correction happens in the market, of course, it always comes to an end, and that end becomes a huge opportunity, especially for options traders. And so the great thing about options trading strategies is that you get to choose how much risk you take and how much reward you'll get based on what you think is likely to happen. And so that's what we're going to be teaching you in today's video in detail. 3 different strategies for playing the end of a sell-off. Before we get into the 3 strategies we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay out the groundwork for you to understand the option strategies we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. There's some traders who like to look at the RSI indicator as a way of determining when a sell-off is coming to an end. And so it's widely believed that when the RSI indicator hits 30 or below, that signals the end of a sell-off. And as you can see from this price chart, that actually happened on March 10th. So there's a school of thought out there that end is near for this NDX sell-off, which in many ways is the driving force behind the broader market. And so let's take a look at an earlier instance of this, which happened almost a year ago, back on April 19th of 2024. And as you can see, the index closed at 17,037.65 that day. And so if you were a believer that this was a bottom of the tech sell-off back in April of last year, and therefore you were bullish, one of the highest probability trades that you can make, which is something that you do if you felt that the sell-off is probably over, but you'd like a nice margin of error if you're wrong, is to pull up an options chain about 2 months out, the June 21st options chain, and look at that column called Delta that will be available to you on any options broker's trading platform. And you look for the 20 Delta option, which in this case is the 16,200 put option, which incidentally is over 800 points below where the index is trading. And you sell one of those for a price of $200.55, and then you head down further to the 16,025 put, and you go ahead and buy that one for $172.40. And so what you've done is to enter into what options traders refer to as a 20 Delta put credit spread, which is a very high probability conservative options trade, and we'll show you why in a minute. You might be wondering what this delta thing is all about, so let me explain that to you. You see, the delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the stock itself moves. And while it's a little bit of a complicated topic, suffice it to say that an options delta has also been found to be highly correlated to the probability that an option will expire with value on the day it expires. And so the delta is telling us that there's only a 20% chance that that put option that we sold will expire with value, meaning that there's only a 20% chance that the index will close below its strike price of 16,200, which is way, way below where the index is trading. And that in turn means that there's an 80% chance that that put will expire with no value on the day that it expires. And obviously, there's an even greater chance that the option we bought below that will also expire with no value. And you may be wondering, why would we do something like that? You might be wondering, why is this a bullish trade? So let's try to understand. So to do that, let's first be clear on what has happened from a cash flow standpoint on this trade. And so starting with the 16,200 put that we sold, we received a price of $200.55 for that. But remember, each put option pays off at a rate of $100 per point that the index closes below that put strike price of 16.2. So we multiply that price by 100, meaning that we'll actually receive $20,055 for selling that put. But then we turn right around and buy that protective put down at 16,025 for $172.40. So we'll pay $17,240 for that put, meaning that our net positive cash flow will be $2,815. And our broker will in turn require us to have $14,685 in our account to make this trade, which is the trade's worst case loss scenario. So keep that in mind. Okay, so now let's move to the last day that these options can be traded. And so that would be June 20th. And as you can see, the index had rallied significantly since we first entered the trade, closing at 19,752.30 that day. And so what has happened with our options trade with the index closing at 19,752.30 on the day these options stopped trading? Well, starting with the $2,815 that we first received when we entered the trade, if we move on to the put that we sold, well, that's expired more than 3,000 points below where the index closed. And the put that we bought below that was even farther below the index price. And so both options expire worthless, meaning that we simply pocket the initial cash that we received at the beginning of the trade for a win of $2,815, a return of over 19% in 2 months, which is certainly solid, particularly when you consider that there was an 80% chance of winning that trade. And so now you understand why this is a bullish trade. And that's because we entered into a trade where initially we received cash, and where if both options expire worthless, then we keep that cash. And so of course we want both options to expire worthless. And we made that extremely likely to happen by selling those puts so far below where the market was trading when the RSI hit 30, that there was only a 20% chance we had to pay off under that put option that we sold. And when the index rallies, then obviously it's moving farther from those puts, which will mean that as the trade rallies, its probability of winning gets even higher. But what's perhaps more amazing about this trade, if you think about it, the fact that even if the index had fallen 1,000 points from the price it was trading when we first entered into it that morning, 2 months earlier, we would have still won $2,815. Why? Because at any price at or above the short put strike price, we make the full original cash flow as our trade profit. In other words, we would have made $2,850 at any price above $16,200 in this case. And since there was an 80% chance of that happening, that's pretty cool because it means the trade had a huge margin for error. Now let's move to the next strategy that we could have implemented on that day if we were feeling that the RSI indicator was pointing bullishly. And this is a strategy where you feel pretty good that you're at a bottom and you're willing to get into a trade with a little bit lower probability of winning, but you want to get rewarded handsomely if you're right. And so let's take a look at how to put this trade together. So this one starts out with a put credit spread again, but you'll notice this time the short put is at 44 delta, the 17,325 strike price, right below where the index is trading, and the long put is 150 points below that at the 17,175 strike price. And so because the delta of the short put is 44 deltas, it means that in this case there's a 56% chance of this trade winning. So it's still a probable trade, but not nearly as likely to win as the 20 delta put credit spread we just looked at. And we'll collect a price of $511.40 for that put, while paying a price of $452.70 for the protective put at $17,175 that we bought in a similar move to what we did in the previous put credit spread. And just like that one, when we do the cash flow analysis, we see that in this case, we bring in $5,870 for the trade. But we're not finished yet, because on top of that, we're going to go up to the call side and find the first call we can find, for which we'll have to pay a little bit less than what we just received for selling that put credit spread. And remember, we just received $58.70. And so we picked the 19,300 call, selling for $51.80. And why do we pick that one? Well, if we now subtract the cost of that call to the cash we received selling the put credit spread, you can see that we still have a credit. Of course, it's quite a bit less, but it's still positive by $690. And that was intentional. And we'll explain that a little bit later, but we do want to point out to you that this combination, the put credit spread combined with a long call expiring in the same month, is known as a modified risk reversal strategy. And it's used when you're more than a little bit bullish. So you're willing to set up a less probable trade as long as you're going to get rewarded really handsomely if you're right. And so if we turn to the day these options stopped trading, June 20th, as we showed you before, the index closed at 19,752.70 that day. So let's take a look at the value of each of the options in the modified risk reversal trade at that point. And as you can see, taking into consideration the $690 we first collected, both puts expire way below the index closing price, so those have no value. But that call we bought, well, the index closed at 452.30 above that call's 19.3 strike price. And so that is going to pay off a bunch. 452.30 times 100, or $45,230, as you can see, which means that the full profit on the trade is $45,920, a return of 320% on original capital. And one more really important point. This was a great outcome, no doubt, right? But what's important to realize is that the trade would have made at least the initial cash flow as long as the index closed anywhere above the short put strike price of 17,375. Why? Because in that case, then we'd still be able to keep the $690 because both puts would have expired, even if the call didn't have any value, which would be the case if the index never reached 19.3. And so this kind of outcome, this spectacular win, is going to happen now and then, but don't forget, there was statistically a 56% chance that we would have made something on the trade, which is why this is such a popular option strategy if you feel really strongly that there's going to be a bounce, but at the same time, you'd like it to be likely that you're going to get some reward, even if the index doesn't really move. And then, of course, is the last strategy we'll be covering today, which, of course, is the simplest strategy of them all, and that is to just buy a call. And in this case, we'll choose the 20 delta call, the 18,650 call, which is a much lower probability trade, as you probably have deduced by now. It has a 20% likelihood of expiring with a value on the day it expires. And so it has an 80% chance of expiring with no value, expire worthless. And you'll notice that its strike price is way above where the market was trading that morning, more than 1,300 points higher. And since this is such a low probability trade, it had better be a tremendous upside if we're right to enter this trade in the first place. And so you've got the RSI indicator providing a bullish clue, but you can't know for sure if the market will bounce at all, or for that matter, how far it will go once it bounces. And so it's a risky trade that demands a large reward. And just as in previous cases, just to make things apples for apples, the trade would cost $14,460, as you can see, which of course is the cost of the call. Now, if we again move to the final day that this call option trades, and as we saw earlier, the index had closed at 19,752.30, then we do the calculation of this call's value, which, as you can see, is now 1,102.30 in the money, and therefore has a value of $110,230, which when you deduct out the original cost of $14,460 results in a trade profit of $95,770, a return of 662% off of our original risk. And so what I'd like you to take away from today's video is that if you've formed the view that a bounce is coming in the market, option strategies can give you a wide spectrum of choices, from the 20 delta put credit spread, which is a really high probability trade with nice returns, the risk reversal strategy, which allows you to have an outstanding outcome as long as the market doesn't move down. In other words, unless you were completely wrong, you'll make some money for sure as a result of the initial credit that you receive. And finally, if you are super bullish, you could keep it simple and buy an out of the money, say 20 delta call, which provides you with a spectacular potential profit, but of course it's a much, much lower probability trade. And the beautiful part is that the choice is yours. You can fine tune your trade ideas to exactly what you think is likely through the flexibility of options trading strategies.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.